Again, you will have the time and the opportunity to put questions to the panelists later on, either here in the audience or if you're online as well. But first, Lasse, let me just pick up on something that you said there. Obviously, if all the investors are ESG aware, I think that's what you call them, they would assume that, or they would sort of appreciate, okay, maybe the returns are going to be somewhat lower. But then that only works in a world in terms of incentivizing a company to change its business model if there aren't other very savvy investors whose animal spirits kick back in, they want to make a profit, and we see that happening in real life. I saw an FT article about it, hedge funds stepping in, they're buying beaten down shares, I don't know if they're actually beaten down, but shares of oil and gas companies because they're looking to make a quick buck. In practice, it's very difficult to actually induce that the change in behavior, isn't it?
Yes, I agree with you. I think, first of all, obviously, if everybody does this, it could have a big effect, but everybody will not do it. Even if many people do it, let's say even half of the people, we have a calibration in the paper, and we find that the effect is quite modest because these things are very substitutable. So that is certainly, it will not completely eliminate the effect that there are some investors who are willing to go for the higher returns on the brown stocks, but it will make it very difficult to have a large effect. And that's related to my point about, can we dial it up? Can we find the right level of impact? It's not clear, even if there is a non-zero impact, whereas, a carbon tax, we could, adjust it to the right level. How do we adjust responsible investing to the right level, I think is a difficult task, if not impossible.
Mm-hmm. Absolutely. I mean, Elisa, you talked a little bit about the greenium, which we see in the equity markets, but also in the bond markets. In the bond markets, you see a lower cost of capital. Is that something that you think will persist? You said before you don't know what the trajectory really is, but at some point, I assume, every bond that will be issued will be green because everyone will sort of have a green footprint. Do you think, if you take a look at the drivers of that greenium, what do you see happening?
So the first thing that I would say is that what does it mean that the economy will be green? It means that the brown sector will disappear or not. So this is the main question around to the fact how will be the greenium in the futures. And moreover, I think that this is linked as driving for the greenium to the ESG preference of our investor. So if all investors think that ESG is a value, then the greenium will become less and less, I guess. And at the end, we should have a new equilibrium in the asset pricing setting. Mm-hmm. There are several theoretical papers that provide, for example, a sustainable capital asset pricing model that is something different to the classical one, because it considers also the utility function of the investor that consider environmental issues.
It's quite interesting, and I want to bring in the financial industry in the form of UBS, because Sabine, you said before that you don't have to sort of sacrifice returns for doing good. But when you talk to your clients, are they happy to accept the greenium? Are they happy to potentially forego profits or higher returns? Or have you not even seen that so far? I mean, because UBS Wealth Management a couple of months ago said our preferred investment solution for wealth management clients is to invest responsibly. I mean, how has it gone so far, and what is the response from investors?
I would say that you see more and more investors taking choices. That's what I said at the beginning. You have very, very wealthy clients who, from a personal conviction, don't want to invest in something that does not compare to their sustainability expectations. And we are seeing that more and more. And I don't think that it's only the more wealthy client, it's just because it's more evident. I think across our whole client base, we are seeing not only the willing, but the non-willingness of investing their own savings, their own money into something that they don't believe is sustainable for their lives and for their future lives of their kids. Mm-hmm. So I'm seeing a huge trend in there. And yes, you're right. Would they go as far that they would lose money? I don't know, but there is enough evidence that there's no downside of investing in sustainable. So I think that's what they're very well aware. So I see a strong trend in there.
What I'm somewhat concerned about is if all this money that we're seeing sloshing around, it's going into sustainable assets. We see a lot of sustainable funds. And what if this becomes a crowded trade where, and as we've discussed, returns fall, and then we don't really know if the returns live up to expectations, and what we're seeing is a lot of backlash coming from some of the critics. We've all heard from the likes of, the former executives of BlackRock saying it's just placebo for the markets. The banks are doing this to achieve higher returns. Well, what if we're left with that? We don't really know if it makes a difference. We don't know whether the return is there. Is it just a marketing tool?
So I would say, first of all, the whole notion that you hear a lot and read in the media that there is a bubble, in a way, that's the whole point, that if the green stock prices are higher, again, that means lower cost of capital for windmills. Let's say that's the whole way that it can have an impact. That's, if you really want a green transition, you should hope that this is the case. So this is not a negative. And you should be willing to accept a lower return. And I think perhaps this is the direction we are going. I think for many years there's been a statement in the financial sector that you could get the best of both worlds, and even not just in the short term. It's certainly possible in the short term that investing green is sort of the moral thing, and also as more and more people are going into green, that is a good investment in the short run. But I think the statement has been made that it will always be a good investment, which I think is not true, as this graph shows, that if everybody is trying to do this, prices will be high, returns will be low. But that doesn't mean it's a bad strategy. But it is a bad strategy if people are not honest about it. I think a lot of Wall Street firms, they will say we have two investment products. One is green, one is normal. Then you ask them, so which one has the highest Sharpe ratio? And then most of them will say, well, they have the same Sharpe ratio. They're both great products. They're equally good. They're great products with equal Sharpe ratios. And then you ask, are they identical? No, they're not identical. This one is green. This one is normal. But then, as a finance professor, you know that neither can be an optimal product, because if you have two things that are not perfectly correlated with the same Sharpe ratio, put them together, they have a higher Sharpe ratio. So why does the normal one, which is unconstrained, it should have a higher Sharpe ratio? Because, and another way of saying that's what my ESG efficient frontier says, that curve is hump-shaped. You cannot have, be 2 points on the frontier that have the same Sharpe ratio. So it's not logically consistent, and I don't think it's long-term sustainable to change the world based on a lie. I think many people are saying, let's tell a lie because that's good for the world become greener. But I don't think that's how you convince investors over the long run. I think a lot of the investors who matter here are institutions, large, sophisticated pension plans, high net worth individuals. You're not going to change their investment behavior based on a lie. You're going to change it based on being honest and explaining this is the way the world works. We can use ESG information perhaps to predict profits, and that gives you this portfolio. Sometimes it will be green, sometimes it might be brown. Or you can say, no, we want, because we like green, it's a preference thing to have a green portfolio. That might not have the highest return, but,
Right. But are you convinced that the lie is that the return, or is not the bigger fear that the lie is that it's really not green? So at the end, I don't think that investors are so concerned about, look, if we invest, there are risks, right? If not, you don't invest. So I don't think that investors need to listen and to hear that it's a lie. I think much more we are fearing about the lie, is it green or not? I think that is the much bigger question. If I go out as a financial institution and say, this is a climate-aware fund, right? How can I trust that this is that climate-aware, and that if I'm investing there, no matter what the risk is, that I get the green I want? And I think that's the the lie, I think investors are fearing more than the lie about the returns.
I think that's certainly
And
true.
lie, I don't like anyway, the word, to be honest, but
No, that's the thing you should read in the media, but I think what you don't read in media is this other, I think they're both problematic, that if you're selling a fund which is, if you claim that it's green, it should be green. If you claim that it, to the best of your knowledge, is the highest possible return, it should be, to the best of your knowledge, the highest possible return. Now, of course, in finance, the returns are so noisy that the latter is not getting much attention because returns are so random that who knows what has truly the highest Sharpe ratio.
Right, but in a way that's where the regulator comes in. And I know that you work on you're a scientific officer, you don't represent Ursula von der Leyen, but I know, we all know, there are a lot of rules. And you said, I think, 550. It's a lot of rules.
Yes.
SFDR is something that the asset management industry has to contend with. It's a very important step towards trying to get rid of greenwashing, isn't it?
Yeah,
but it's also a lot of bureaucracy.
It is indeed the clue point of this discussion, because we say that the investor knows what is green and what is not green at the end. Because you say you use two different assets, how you can say that this is green and this is not? So it is really important, the work that not only the European Commission, but all the governments are doing in order to find a similar disclosure, the same standards to define what is green and what is not. A first step was done by the EU taxonomy regulation, but it seems not enough. And now there is this discussion on the EU proposal for the Corporate Sustainable Reporting Directive that will enlarge the scope of the non-financial directive. But another clue point that is not covered, I guess, is what about the small and medium enterprises? Because when we think about disclosure, we have in mind companies that are listed and can also invest in disclosing. But what about the other one? So it's really important that when we talk about disclosure, we talk about climate change, to have in mind all the agents of the market.
I just want to move on and share with everyone what certain parts of academia is saying about whether sustainable investing can save the planet. Just to quote research here from Blanchard and others, for seasoned publicly listed companies, stock prices seem to have no substantial effect on corporate investment activity. Other research shows from Chava, if you're a really big company, if you have a good ESG rating, you may enjoy a lower cost of capital. It's not sure whether this is down to the investor impact that we're talking about or the superior risk characteristics of those companies. So I know there's a lot more to this in academia, but the point is, and what I've come across is that there's a lot more to be said about the engagement with a company. I think you pointed this out. So the voice element rather than the exit element, so divesting of a company. Is sustainable investing still useful, even if we know whether it's from real-life examples? I guess one of them being, engine number one in ExxonMobil, that was extremely visible in the media, or Third Point and Shell, wanting Shell to be broken up. So whether it's academia or real life, do we still hold on to sustainable investing, even if we don't know what the effect really is?
I mean, I think it's not something for you and I to decide, because every investor invests based on their own preferences, and so there is a lot of investors who want to invest in green products. So I think it's here to stay for the foreseeable future. I think I personally think it has some effect, but it's hard to see that alone will really meaningfully cut carbon to the kinds of levels that we're hoping for. And so I think the whole political economy that Jean Tirole will talk about later it's also interesting to think about, is this whole sustainable investing framework, is that something that diverts attention so that people forget about doing other things that like a carbon tax that might be needed? or is it something that really creates a political engagement with the topic that will then make a carbon tax more likely? It's difficult to see. I do think when I hear all the word taxonomy and all these complicated things, and I envision all the lawyers making corporate life very complicated in Europe and very inefficient perhaps, I really personally think that going the route of just having tons of lawyers regulating all the companies and first spending years talking about what do these words mean and what's the legal meaning, and I think that will just take Europe down the path of slow growth and not solve the climate problem in a very effective way. I think the better bargain for Europe would be have a tax, started with it extremely low so nobody minds, and then have an efficient set of regulation that doesn't burden companies, that lets companies do what they're normal. When we talk about rewiring the economy and all these things, I think it makes things too complicated. This is actually not complicated. We don't need to reinvent. We're not going to Mars here. We're not rewiring the economy. We're doing exactly what we've always been doing. We start with a very low tax, and when we give it back to people, it's not money that will disappear. It's actually your own money. You'll get it back, don't worry. And then we slowly increase it, and then it starts to become super profitable to do green things, because if you can save people this tax, then you can make tons of money, and it'll spark tons of innovation. And I think the reduction in GDP that we'll see will be much less than people think, because people forget that people can make a COVID vaccine in a year when there's a market for it, and there will be a market for making green stuff when there is this tax to be. People will do anything to avoid a tax, and if there is the tax to be avoided, it will spark tons of creativity. I think another objection is, it will only work if it's global. This is true, but what does global mean? It means Europe, China, and the US has to agree. It's not that hard. It's not 100 and some countries. And if those three agree, everybody else will fall in line. So it's not really that hard. It's not going to Mars.
Well, thank you so much for that. We'll discuss this in further detail later on today. I just want to give Sabine another chance, because obviously UBS is very committed to sustainable investing. Again, the jury's out whether it will actually make a difference. But you said before in your opening remarks, there's another very important and useful mechanism of steering the economy and the businesses in the right direction, and that is through financing. How important is that as an element?
Financing the transition, you mean?
Yes.
Yeah, very important. I think that's part of our sustainable strategy, supporting our companies, the smaller, the bigger, and the very big ones, in the transition from a more brown to a more green business case. And I think there's a lot of financing to be made and investing into innovation to get there. So it's very important. I think it's really the three pillars. It's sustainable products, transition financing, and the real estate aspect, specifically where it makes a difference. Yeah.
All right. Just before we get to the audience questions, and I'm sure that there are many here, do we feel that there might be a rude awakening when we see all these flows going into green funds, into green assets, whether it's in the public markets or in the private markets? Because we've really just talked about the public market mechanism here, but privately there's also going a lot of money into maybe, for example, pre-IPO companies. Might there be a rude awakening at some point, Elisa?
That's really interesting. Yeah, it could be a weakness at some point, I guess. The fact is that we should think to also how private and the public can work together to achieve this goal. So I think that it is based on how much is the effort from all the sides that can help to go in to arrive to this climate neutral transition. As Lasse said before, this is something that we can do.
Sabine, you're not quite sure.
No, I'm just questioning because I'm just asking myself because you talk about awakening or does it really make sense? But at the end, we are all trying to do the right thing for our planet, and maybe elements will succeed, others won't. But I don't think that we should stop any of these activities just because we fear that they might not be as successful. At the end, we are trying to solve an issue where we're all in the same boat. So I don't think that there's a merit for one or the other not succeeding. I know it sounds a bit philosophical, but I think that also boils down, right? Let's try together to make the right thing together.
Yeah.
So
Even
maybe there is a bad awakening, but there can be also another innovation that we just have invested, and it shows that it's not so green that we thought, or whatever.
So even if we create asset bubbles on the way, is that a view or a fear that you share?
No, I think it's fine if green assets have a high price. That's fine. They'll spur investing in those businesses. I don't think of it as a bubble. I think of it as the flip side of people wanting green products. They express their views with put their money where their mouth is, and that benefits the company. So I think bubble is a word that is thrown around a lot, but I don't think it applies in this particular context.
I mean, obviously, you made your case for the carbon tax. Do you think, because we talk about whether sustainable investing is useful or not, could it be a nice, maybe a smoother, more palatable segue into the carbon tax for governments to accept, yeah, we see all investors doing this. You know, this seems to make a lot of sense, and we can get everyone on board. Is that a useful mechanism, potentially?
Yeah, I don't know how politics work so well, but it would be nice if it was. And I do think certainly it's something, it's surprising in a way that we expect investors to solve this, not governments. It seems like it should be a government problem, not an investment problem, but if the government won't fix it, it's a start.
All right, let me stop here because I assume there are a lot of questions. Sabine, unfortunately, will have to leave in a few minutes. Maybe she can, is there a question to Sabine specifically? At this point, let me also check online. We have, there you go, in the back. We have mics here.
There's also one on the left.
Oh, yes.
Thank you for your explanations. I'm wondering how many years you typically grant the company to do the transition to become at least CO2 neutral, if not negative at all.
The time, I think that's something, it depends. I don't think that there's one time, but I think you need to believe in the strategy. Is the strategy the right one? And you need to test the strategy. I think that also then shows based on targets if they achieve it. I think that's much more important. What are the milestones to achieve on the strategy, and how credible is the strategy more than the time you give them?
I mean, if I remember correctly, the slide that we've seen from Dr. Kielholzer, time is ticking away, and I wonder how much time we are willing to give ourselves to make those changes happen.
I think we have given us too much time anyway already now, right? We know that we don't have time.
Thank you.
Yeah. I think there was a question over there, specifically to Sabine. Yeah.
Yes, thank you. Yes, specifically to Sabine.
Sorry to put you on the spot here. But
Sabine, what's your favorite ESG product UBS offers?
Oh, that's so easy for me. The Key4 mortgage, because it's a part of my remit which I developed. So it's a green mortgage.
I saw another one. Over there.
But we can open up, right?
Okay.
Thanks also to Sabine. Maybe a bit of a provocative question. I mean, if we assume that individual investors would accept lower returns for their products, would banks also accept lower interest rates for companies they know that invest in green products or that are generally green companies? I know it's not that easy, but in general,
but we're seeing that also specifically on the, sorry if I'm going back, but it's an example, the real estate price, right? The question is, how much premium do you give to green real estate? And I think that's a discussion that we are having to understand how far can we go. And so I think we all need to ask our questions on that. So, yeah.
A quick one from Ernst.
So from my own research, I know that maybe the single most important fact in human societies is that people are different. Mm-hmm. And that means that we have investors that care about the green products, and we have investors that don't care. And the share of investors that don't care is typically substantial, maybe a substantial minority. And that means that, let's say, if many people buy green products, then these products become more expensive, the cost of capital become lower for these green firms, but at the same time, capital is withdrawn from the brown industries, and the brown industries become cheap. Mm-hmm. And so all the selfish people, so those who don't care, those who don't care for the green products, they have huge opportunities by going into brown industries. Mm-hmm. And so I wonder whether we can ever have a big impact at the societal level from sustainable investing as long as we have a substantial share, and I strongly believe, all the evidence says that, as long as we have a substantial share of people who still don't care for the green things. And that's a question to everybody on the podium that I would like to ask you.
All right, I'll let Sabine go. I know she is under time pressure. Who wants to take this?
Yeah, so I totally agree that there are certainly investors who only care about the financial objective, and they will go for the brown assets if those assets have higher returns, and that'll diminish the effect of the green investors, diminish it to perhaps such a level that it's not going to really be enough. So I think that's a very legitimate concern. At the same time, I don't think they will fully undo it. There will be some element left, but it's certainly an important consideration to keep in mind.
Yeah, I agree with your comments. And when you talk about that, I was thinking to the fact that the sustainable investing is not enough per se in order to achieve the goal of climate neutral. So at this point, in order to have a good success, we should also use several policy action, or not only policy action, but other action that can help us to face with these issues.
So I think as one reflection of this issue is, if you think about how you should apply the sustainable investing versus a carbon tax in terms of who's considered brown. So one of the issues in sustainable investing is whether you should think about what's called scope 1, scope 2, or scope 3 emissions. So scope 1 means that your company is itself emitting carbon into the atmosphere. So let's say you're burning oil to produce electricity. And so those are the kinds of companies that would be paying a carbon tax, and only those companies. And then there are other companies that, let's say, buy the electricity that is made with this oil, and so they have what's called scope 2 emissions, or are buying their products or selling cars to other people who will then burn. That's called scope 3. Now, the normal way that we think as economists is to fix an externality is that if somebody is polluting, then we should tax the externality, which is the actual process of submitting carbon into the atmosphere. And so that's how a carbon tax would presumably work. But if we think about sustainable investing, actually most investors, they say, no, we should think about the whole supply chain. We should think about not just is this company itself emitting carbon, but did they buy products that were, and what, that difference tells me that, why is there that difference? Is it because that what could work is you just don't invest in the people who emit carbon. That increases the cost of capital for, let's say, energy producers. Energy prices goes up, and it filters through the supply chain. And by itself, sustainable investors shouldn't have to worry about Scope 2, Scope 3, because the price mechanism will fix it. But if you think, no, this actually doesn't work very well, we have to also think about Scope 2 and Scope 3, because we haven't affected electricity prices, because then you're kind of admitting almost that you don't think your mechanism really works that well, so you're trying to apply it more broadly to hope it still works some. And again, if a lot of investors will only consider a very small part of the economy brown and change the prices of those, they will also change the price less, because that means that the investors you're talking about who will jump on to the high returns, if they only have this tiny part of the economy to buy, it'll be really difficult to have an effect. So you need actually a large part of the investors are doing it, and the large part of the investors have to make big shifts across their entire portfolio, not just a tiny part of their portfolio, to have any hope of an effect.
I have another corresponding question here from the audience. Are dirty companies not simply forced off the stock market because of sustainable investing? So, maybe they say the scrutiny is too big. I'm going to go private, or maybe I won't even do the IPO that I planned after all, because first of all, I don't want to be considered that's my interpretation of the question, but I don't want to be seen as or considered a brown company, or even if I'm in transition, well, there's a lot of scrutiny on my transition path. So maybe I just stay private. Maybe the public market is primarily green, but the private market isn't so much. What if we get the arbitrage situation?
Yeah, so I think you're right that there's more scrutiny in the public market. I think what some people also maybe think that, if everybody sells the shares, then this company can't exist. But that's actually not true, right? Because for every seller, there is a buyer. Once a company is there, it's not, sustainable investor is not going to make the company go away, whether it's public or private. The company is there, it already has the capital. What sustainable investing can hope to affect is which company can build a new factory and which company will have to let their factories depreciate over time. So it's something that has a hope of having an effect over time, but it's not something that will immediately shut down the brown companies, because you can try to sell your shares, but if you sell them, there will be some buyers, or you don't manage to sell them, then you're stuck with the shares. But either way, the shares are there.
Right.
Yeah, I think that also another piece of puzzle that could be important in this point is that the reputation of the brown companies in order to achieve the transformation. So we should think that a brown company, even if it is private, it can be interesting to change its process and to try to insert adaptation and mitigation strategies in their process in order to reduce or to improve its reputational perspective.
Mm-hmm. I think we're slowly but surely running out of time, but I want to come back to some of the audience questions which got the most likes. This is not Facebook or whatever it's called now. This one got a lot of likes. What is the role of central banks regarding sustainable investing? I know that there are certain central banks out there which think it should deserve a larger role. Some say we need to stick to our mandate of price stability. Any views on that? Are certain, and again, my interpretation, my addition to this question, are certain central banks overstepping their mandate?
I think there is a political push in some circles to, get these green mandates in through the back door in various ways. And so central banks, to the extent they regulate commercial banks, they can, perhaps restrict lending to brown companies and so on. I would say that would be overstepping the mandate of central banks. And I think it's going down the path of the lawyers rather than the path of the more efficient pricing. I think central banks could to the extent that they're making a fair assessment of systemic risk and taking climate risk into the systemic risk to the stress test, I think that's certainly legitimate. But it shouldn't be, making an unrealistic case for political reasons. I think it should be a realistic stress test. And also in that connection, the transition risk could be important, because if we have suddenly a carbon tax, for instance, even before we have all the hurricanes or whatever, then that could have a big effect on companies, and that could have, affect banks, the financial system. And to make a carbon tax feasible, we have to know that we are not going to wreck the economy. So to do the calculation in advance, to do the stress test, and to say, look, the economy will be fine if we do this. Again, I think the way to do it is to start low and ramp it up slowly. But even aside from that, I think preparing the financial sector for this through stress tests is certainly a good thing.
Yeah, indeed, the Renew Sustainable Finance Strategies as a stronger pillar on the fact that the European Central Bank has to develop climate stress that incorporates climate risk in as a systemic risk. Moreover, we can also mention the network of central banks that are working on this stuff in order to include climate risk as a systemic risk, not only in stress testing, but also in climate scenario analysis. So they have a crucial role in that sense. Yeah.
Are there any further questions in the audience? Yeah, over here. It's just if you can pass it.
See if this works. So I'm wondering, I've heard green and brown companies in terms of sustainable investing. And I'm just wondering, if we talk about economics for society, I mean, the term of sustainability, shouldn't that be extended maybe also to labor, to income, and to making society empowered to make sustainable decisions, purchase decisions?
I agree with you, because one of the slides that I presented before, I said that it is really important to think to climate change, not only focus on environmental issues, but also on social aspects, like, for example, labor market and whatever. So this is another point that should be emphasized in this transition, because in some sense we are trying to find a new equilibrium between sustainability and the economic growth that can be defined through all these social aspects.
Before we wrap this up, we asked you to take part in the poll, and let's see the poll result, because it's quite interesting to see what you thought before the discussion. I'm curious to know whether you actually thought after the discussion whether you would change your mind, but what do you think is the most promising measure to stop global warming? Most of you said overwhelmingly carbon tax. 21 said emissions trading scheme, 28 slightly higher than the cap and trade, sustainable capital markets investment. Quite interesting. We know some sort of government intervention will be needed, I guess. Up for discussion is how it should be structured. You say it should start quite low and then we should ramp it up. You could also argue, well, maybe it's too low in the first place. If it's too low in the beginning, it really won't make a difference, which is what we're seeing in many, many countries. But we'll have plenty of time during this afternoon's sessions to discuss that further. I want to thank everyone for their time and attention and their participation, and I want to thank both of you and Sabine in her absence for this panel. Thank you so much.
Thank you.
Thank